Before the break, we highlighted that surprise decision by the Bank of Canada this week to raise interest rates again. That took a bite out of stocks earlier in the week and left some stateside investors taking pause ahead of what was expected to be a pause by the U.S. Federal Reserve. That central bank has a rate decision to make next week. Let's bring in David Nelson for more. He's chief strategist at Belpointe Asset Management. David, nice to see you. And I'm curious to know what you think the Fed will do next week.
Right now, the Fed Fund futures say that they're going to pause, and that's really the right thing to do, John. They've already broken a few banks right now. They've damaged the financial plumbing, and they may have to hike again in July. But right now, just take a pause. Kind of take the pulse of what's going on right now. There's some hawks out there like Larry Summers who've come out pretty harsh and said if they do pause, that he wants to see 50 basis points the following month. I'm against that at this point, given what I see. I think the Fed needs to consider a lot more than just what inflation is at. They have to think about the health of the banking system. And right now, if they keep pushing higher, that's a problem.
Well, it's a complicated story we're obviously living through here in Canada as well. Now, for stock market investors, I know people hear about recessions all the time, but history suggests when there's a change in monetary policy direction, that is usually a buy side. We have talked this week about how the S&P 500 has technically returned to bull market status. Does that have anything to do with the fact that there's this idea that maybe a Fed pause is coming?
I think the good news is that the market has managed to move into that mindset, and they've already priced out for most of the year. They used to be on the table just 2 months ago. We were looking for cuts as early as July. That's gone. Now the thesis is that maybe we'll see some kind of a cut in January. I think that's kind of good news. It tells me that the market is resilient enough and the health of the economy is strong enough that we seem to be able to handle the mindset of a higher for longer dynamic coming from the Federal Reserve. So I think the glass is half full.
You do have, speaking of half full glasses, you have a tale of different sectors so far this year. Most of our audience knows tech has been on fire and other sectors not so much. What have you made on where the money's been going?
I don't know if the trade has legs, but something changed last Friday on our jobs report. Coming into June, the spread between the best performing sector, tech and energy, was 44%. That was just dying to be collapsed. And for the next several days, we had a pretty meaningful rally in value stocks, small cap value. That seemed to kind of stall yesterday and is stalling maybe to a bit today. If that rally has legs and that changeover, that tells me that we're going to just, we're going to broaden out. And for the overall health of the market, that's a pretty good sign.
Now, let's put energy in context. You referenced that group. We've got a lot of people in Canada that watch the energy stocks. They were big winners last year. It's one of the reasons why the TSX had better overall performance, albeit negative for the year for the TSX versus the S&P 500. Coming into 2023, we heard about the China reopening trade, a lot of excitement about what that could mean. But in reality, some of these global economic weakening signs have weighed on crude prices. What do you think the appetite for energy is going to be going forward?
You just named the big problem, and it's China. China has stalled in their post-COVID, their zero-COVID reopening. They seem to double down on bad policy, and they're still the second largest economy on the planet. So if they're slowing down, that's got to be a hit to global growth. Hence, that translates to the commodity index, and of course, that translates to energy. And I think in large part, that's a big part of the reason why energy hasn't returned to some of the higher levels that we saw last year. So we'll have to see what happens there. Add the dynamic right now that we're kind of in this process as a world decoupling from China, and that's likely to continue, especially given now that they're rattling the sabers. They're an increasing military threat. We had an American ship and a Chinese ship kind of butt heads in the Taiwan Straits, and now we find out this morning that they're going to be putting eavesdropping facilities in Havana, 90 miles offshore. Doesn't play well for the idea that we're going to work together and be friends.
So putting everything you've said together for a basket of investment ideas, what's your best advice to investors these days?
I think you're going to have to be across the board. You know, it's been pretty tough to manage the massive swings that we see from one side of the lifeboat to the other. I grant you that large cap secular growth, it has been the trade all year, and I'm certainly invested there. But I think you're going to have to make room as we move down the valuation curve and move into some of these more cyclical names. We've had some meaningful moves out of names like Caterpillar, industrials. I find that to be a very healthy sign, especially small cap value. It's the kind of thing that starts to work coming out of recession, not going into recession. I think that unwind is very healthy.
David